unmuted.
Welcome to the ISG quarterly call, reviewing the first quarter of 2016, entitled The Price is Right, A Look Inside Market Valuations. My name is Howard Coleman. I'm the Chief Investment Officer of Coldstream. And with me today is James Walsh, the Portfolio Manager for Kevin Wilson's team. I will be providing a market recap for the first quarter, and James will present our special topic, which for the call today is on equity valuation. There is a box on your screen where you can type in any questions you might have. We will try to address all of your questions today, but if we do not get to all of them, please contact your relationship manager or your portfolio manager with your question. While we have scheduled this call for 30 minutes, please bear with us if we run over a bit so that we can cover these topics thoroughly for you. Turning now to the market update. The first quarter was a tale of two different halves. The first half through February 11th was characterized by fears of slow global growth, especially in China, a possible recession, and conflicting statements from members of the Fed as to how aggressive it would be in hiking this year. In the second half of the month, statements from the Fed became uniformly dovish, the dollar fell off, oil prices stabilized, and the equity markets rallied. You can see this dramatically from this chart. As you can see, as of through February 11th, the S&P was down over 10%, but recovered to up 1.35% by the end of the quarter. The Russell 2000 small cap was similar, even more dramatic, down almost 16% through February 11th and rallied to 1.5% down. The other dramatic move was in emerging market equity, which has been beat up for an extended period of time. It was down over 10% through February 11th and then rallied to up 5.71% year to date. Excuse me, through March 31. The second chart is really interesting, and it talks about four categories: the S&P 500, crude, JP Morgan stock, which I'll explain why in a minute, and the U.S. 10-year yield. We can see at the end of the year last year that the S&P was at 2,044 and dropped dramatically to January 27th. Crude also dropped, as did JP Morgan stock, and the yield on the 10-year also dropped. On February 27th, the Fed left rates unchanged after raising in December. That was expected, and it did not really move the markets. On January 28th, the Bank of Japan adopted negative rates, negative rates would mean that when a bank leaves money on deposit, which they have to do to meet reserve requirements, they have to leave their money on deposit with the bank overnight. The bank, typically, the Bank of Japan is, by the way, the equivalent of the Fed for Japan. The Bank of Japan typically would pay interest on those overnight reserves, but now they're making the banks pay interest, and the reason is they want the banks to spend as much of those reserves as they can, get them out of savings to stimulate the economy. Well, that had no effect on the markets either. On February 11th, Jamie Dimon buys 500,000 shares of JP Morgan stock, announced after the market closed, and as correlation, not claiming it was causation, because there's certainly a different opinion as to that, but that is the point in which the market closed. As you can see, the market reversed, excuse me. You can see as of February 11th, we were at 1829, but in March 4th, 1999. Crude rallied, JP Morgan stock rallied, and Fed rates rose again. It was a risk-on environment for the second half of the month. Was it caused by Jamie Dimon showing confidence in JPM stock? That's a question open for debate. We certainly have one money managers that I know that definitely attributed to that. There was a second significant event during the quarter that had an impact on the markets reversing, and this is DXY. What DXY is, it's a measure of the dollar versus a basket of currencies. And we all know that the dollar has been strengthening significantly last year. Well, the beginning of this year, it weakened, but then it began to strengthen until February 29th. As you can see, that's a turning point. What happened on February 29th? There was a G20 meeting shortly before that. That's a meeting of the people in charge of finance for 20 of the largest leading economies, and Janet Yellen was there for the U.S. Before February 29th, the Fed was very divided in statements that different members were making as to whether there was going to be a raise soon or not. After February 29th, the Fed was uniformly dovish, and that also had an impact on the market. What was said in Shanghai, we will not know, but we do know that the Fed tone changed to become uniformly dovish after that. That had a strong impact on dollar weakening. And when dollar weakening, that also impacts commodities, and I will get to that in a minute. The other thing that happened in the month that was very interesting is you have factors in the equity world, factors that stocks respond to, and one of the factors is momentum and the other is value. And last year, momentum significantly outperformed value. But in the middle of the quarter, that dramatically reversed. And this is a chart that shows if you went long momentum stocks and you shorted relative to short momentum stocks, you can see that momentum significantly rose for the first half of the quarter and dramatically dropped off. The bottom half of the chart shows the volatility involved in that and how unusual it is that event occurs. One standard deviation is about 66%, two standard deviations is about 77% of the time. So this is very, very rare. Greater than a 2 standard deviation move. In other words, it happens probably less than 2% of the time. So it was a dramatic reversal between momentum and value. There's very different reasons for it. One of the reasons that I've heard that does make sense to me is that there were some dramatic hedge fund liquidations as some hedge funds lost assets, and those hedge funds were heavily in the momentum trade. So what does the S&P look like now? And this is still not a great chart. We haven't passed the previous highs, and we have headed down a bit since then. Even though the rally looks very good, the possibility of a breakout is there, but it still is not a good looking chart. On these, I'm going to be talking about charts and technicals here briefly. James will cover valuation and whether the S&P is cheap or not, which is a completely different discussion. The Russell Small Cap Index is a chart that actually looks worse. You have lower highs and lower lows, and even with the rally, we have not yet exceeded the previous highs, and this is still not a bearish chart. A bullish chart. We would need to run a bit more before it becomes that. Emerging markets, however, look better, and even though we haven't passed yet our previous high, we have been in this market has underperformed for such an extended period of time, and valuations look attractive that this chart, although not broken out as of yet, we think has a better possibility of breaking out. And as many of you know, at Coldstream we have an investment strategies group composed of myself and the portfolio managers, and previously we had an underweight to emerging markets. With this rally, we've made it an equal weight. We haven't gone overweight as of yet because we're not completely convinced of a breakout, but this is a better looking chart. The thing that has persisted and continues to persist and has been especially strong in the last couple of years is the inverse correlation between dollar and oil. And the red line is oil prices, and it's reversed. So the red line, the higher the red line, the lower the oil price. And the higher the blue line, the higher the dollar. So as the dollar strengthens, oil weakens. And then we can see in the last half of the month, as the Fed was becoming dovish again, since interest rates are low, that interest rates, the idea of the Fed keeping interest rates low has an impact on weakening the dollar, and it did have an impact on weakening the dollar. And with the weakening of the dollar, oil prices rose as well. I think this is probably a result that the Fed likes, but at some point I will show you a chart that they are truly in a dilemma right now. This also has the same impact on commodities. Commodities are traded in dollars, and so as we can see, commodities fell off dramatically as the dollar strengthened in 2014 and 2015, but has come off but as the dollar has come off, commodities have strengthened. This also has to do, I think, with the fact that China is showing signs of stability. The fear of a hard landing is diminished, and China being the world's largest consumer of many commodities, that has an impact on commodity price. The other thing the Fed succeeded in doing in becoming dovish after the, quote, Shanghai Accord is that the volatility in the Treasury market, and this is called the MOVE Index, and this measures how volatile Treasuries are. We can see a dramatic fall in volatility in Treasuries from the middle of the month down. And we can also see yield curve flattening, and what the yield curve is, if you recall, is it's the difference between rates and Treasuries on the short end from 1 month all the way out to the rates and Treasuries for 30 years. And typically the rate in Treasuries far out is the market's anticipation of what inflation and growth are going to be. And as the Fed showed dovishness, we saw continued flattening of the yield curve as long-term growth concerns persisted. The other thing a flat yield curve does is it hurts banks. Think about how banks in your grandfather's bank makes money. Think of how that works, is that they loan money short, they take in money short, your deposits, and they loan money long, your mortgages. And so if the long end of the yield curve comes down and mortgages, they're not making as much money on the mortgages because the mortgages get cheaper, the bank's ability to profit by borrowing short and lending long gets compressed, and this is part of the reason that banks have so significantly underperformed the S&P. Now, with the dollar weakening, emerging market currencies rallied. They rallied both because of dollar weakness and because perhaps the thought is that China may strengthen, and the dire predictions for emerging markets with oil prices rising and China strengthening, a little bit more bullishness in emerging markets perhaps. I mentioned before the dilemma that the Fed is in, and this little chart from a blog I found, I think perfectly describes it. We look at the Fed saying we're going to be dovish, and we have risk on markets, exactly what happened at the end of last quarter. Then U.S. rates rise because the risk-on environment is there, and people think that, oh my God, there might be growth, and rates rise. Well, then there's a probability that there'll be a Fed rate hike, and then there'll be tighter financial conditions because people will be concerned of a rate hike. Then the markets will become risk-off, and the central banks panic. They panic and say, no, we're not going to raise rates, and you have easier conditions, and you start the cycle over. And this really, in a nutshell, describes where we've been for about the past 5 or 6 years. Turning quickly to Europe, the ECB, which is the European Central Bank, the equivalent of our Fed, is actually buying sovereign debt of their countries, just like our Fed buys treasuries. But their target is enormous. Their target is to buy 33% of their constituent countries' debt. As you can see, the dark blue line, they're up to about 10%, 13% of Germany right now, German debt. Next year, they're expected to buy 30%. And so the dark blue line is where they are now. The lighter blue dots are where they are expected to be. And we see significant buying of treasuries, which will keep those yields low because they provide built-in demand for those treasuries. What the result is Europe is flirting with, in many countries, negative rates. And we mentioned what that is in Japan, which is banks who hold money on deposit have to pay the central banks for those deposits. But what's remarkable is, and this is in the blue line, in some countries, when you make a deposit in a bank, your checking account or your short-term savings account actually has negative rates as well. Now, unlike the other EM currencies, China has been stimulating its economy, and the stimulus apparently has begun working. And one of the ways they stimulate their economy is they make their currency weaker. Now, the RMB has not really depreciated against the dollar recently, but China now measures its currency against the basket. And they have depreciated their currency against the basket. This makes their goods cheaper abroad, and it makes it easier to export. And China's been talking about changing their economy from an export economy to a consumer-based economy for some time. But as growth has slown in that country, maybe they have, quote, panicked a bit and gone back to we need growth, even if it means focusing on the export economy as well. And that is part of the reason for this depreciation. Now, the strengthening in China and the stimulus working a little bit is really evident in metals and mining stocks, because metals and mining are, China is probably maybe not the world's largest user of metals and mining, but the difference between the increase in usage is greatest in China. And we can see metal and mining stocks have dramatically rallied since February 1st, and this has much to do with increased confidence in what's happening in China and actually increased orders in China. Turning to oil, rig count, the fundamentals of oil, rig counts continue to decline dramatically as inefficient rigs get closed, even though we're saying oil's at $40 and it's moving up, which it is, but historically $40 over the past 25 years certainly is very low. This is happening while inventories still remain elevated, although we anticipate inventories coming down in the next 6 to 9 months. This has resulted, and this doesn't really have great impact on your investments, but I thought it was just an interesting note. We now are running a trade surplus with OPEC nations, which is just amazing to me and anyone who's been around with gray hair to think that we are now running a surplus with OPEC, given how much of a deficit we have run historically. Finally, the Atlanta GDP estimate for the first quarter was a 4% growth, extremely anemic. The experts were at 0.7, and GDP came in today. First estimate of GDP came in at 0.5. So the Atlanta Fed, once again, was very, very close. Growth continues to be relatively anemic. But remember, first quarter growth throughout the last few years has been much lower than growth later in the year. This is concerning, and this relates directly to what James is going to talk about in terms of valuation, which is that corporate profits have continued to fall. However, LEI, the leading economic indicators, and CEI is the coincident economic indicators. Leadings kind of look forward to how the economy is going to do going forward. Coincident is how we're doing now. And as we can see, how we're doing now still looks pretty good. LEI going forward has flattened out, but it is certainly still no indication of recession on the horizon. So that briefly summarizes my part, and I will turn it over to James to talk about valuation.
Thank you, Howard. All right, so my portion of the call is going to be discussing market valuation. Is the price right? Right now, we have a dilemma. Is the stock market currently under or overvalued? As of today, our latest numbers look like the S&P 500 has a trailing PE of 19. Now, is that high relative to history, or is that high or under relative to other investments one can make? Given the current valuations that we have, what kind of returns can we expect going forward? So one of the first pieces of analysis we need to do when assessing price to earnings ratio is whether or not what measure of earnings we're going to use in that comparison, and this is especially important when you're comparing current valuations to historical valuations. The most commonly cited number for earnings is GAAP. This is commonly referred to as reported earnings. Unfortunately, if you're doing a historical analysis, GAAP has changed over time. One of the most significant changes happened in 2001, where companies were allowed, well, actually the rules changed so that companies could account for goodwill in a different manner. Traditionally, when companies acquire another company and they pay more than book value for that company, the difference is accounted for as goodwill, and that is typically amortized over a multi-decade time frame. Post 2001, goodwill was allowed to be carried at cost and then impaired. The effect of this change means in times of recession or negative earnings, companies have been tending to write off these goodwill amounts, and that causes the earnings number to be much lower than would traditionally have been reported. Fortunately for us, there are other measures of earnings that we can use for comparison's sake on a historical basis. Operating earnings, sometimes called to or referred to as pro forma earnings, typically exclude interest, taxes, and other extraordinary items, and non-operating earnings. This can have an effect of elevating earnings levels over time, and so this number tends to be a little bit overstated relative to actual operating profits, and this is actual profits, because companies are able to label losses as one-time expenses, when in reality, I mean, as an investor, that's an actual real loss and it should be accounted for over time. But if we're looking for an apples-to-apples comparison, operating earnings is a pretty good place to start. And there's one last measure of earnings that we like to use, and that's from a group called First Call, and this is a summation of the analysts' estimates of earnings, and typically this is referred to as forward earnings expectations. These are relatively stable for historical comparisons, and they're also useful because they incorporate growth expectations and the relative bullishness of investors in the analyst class and those people that are making investment decisions. But the downside is that those earnings expectations are typically overstated, especially in the late cycle. Analysts tend to listen to corporate management, and corporate management, generally speaking, is quite optimistic most of the time until they have to show that they've had bad earnings, and in which case they actually go completely to the other side, and then they start throwing in the kitchen sink and really dropping down those earnings for the quarter, and then make very modest expectations going forward, in which case they can then beat. But during periods of expansion, they will typically overstate those earnings expectations. The chart on this page is the earnings per share for the S&P 500 going back to 1991. And the point of this slide is to demonstrate how different these earnings numbers can be and how dramatically they've changed. Prior to this, the 90s, these numbers were relatively stable and close to one another. But again, post-2001, the change in GAAP and the accounting for goodwill and other accounting changes have caused a pretty big divergence across these different earnings estimates. The top line in green is the First Call analyst estimates, and you can see, again, elevated, especially now they're quite elevated relative to actual operating earnings and actual reported earnings. And you can see, depending on what E we use, we're either wildly undervalued or maybe potentially wildly overvalued. And so if we're going to compare over time the current PE ratio, we need to use one consistent set, and I'll do that over the next few slides. One popular measure of price to earnings is this, it's called the Shiller cyclically adjusted price to earnings ratio. This takes the average of the last 10 years of reported earnings relative to the current price. And you can see this is, well, on the screen you'll see this measure over time since 1880. Currently we're sitting at a 26.21 level. Again, this is likely overstated since 2001 because these GAAP earnings on average have a very large losses written into them from the 2002 and the 2008 recessions. So the E is low, so this measure relative to prior history might be a bit elevated. But what I would say is that on the long historical average, we are currently overvalued. We're a bit more normal over the more recent time frame, so saying the last 25 years. Investors prior to 25 years ago probably aren't investors anymore. And the dynamics change over time, and you can also think, over this span of history, we had two major world wars, a major depression, and we also had our own more recent financial crisis. But the one key takeaway here is valuations can get stretched much further. We're nowhere near the highs that we saw in the roaring 20s or at the tech bubble highs. This is a chart of the forward PE ratio, and this would be the based on the first call analyst estimates. By this measure, we're sitting at a forward PE of 16 times expected earnings. Now this sits, if you look in the upper right-hand corner, this forward PE ratio sits exactly on the mean for the 25-year average. So we're essentially fairly valued to maybe slightly overvalued based on this measure. And if you look at the other measures of the past 25 years, we're not overvalued, we're not undervalued, and you can see on the chart we're nowhere near what we saw in the tech bubble era. But I would note both the the Shiller PE, cyclically adjusted PE ratio, and this forward PE ratio, we are now at valuation levels that are higher than we had prior to falling into the 2008 financial crisis. So we are elevated relative to those numbers. And one last takeaway from this, in the bubble that we experienced between 1997 and 2000, it took years of overvaluation before we hit our highs and the bubble finally cracked. So one thing I would note is that valuations can be elevated and they can stay elevated for long periods of time. This is a great breakdown of valuation by segment of the S&P 500. These are the various sectors of the stock market. What you're looking at, every blue bar is the range of valuations. This is the current PE. This would be based on forward PE ratios. Over the past 10 years, that blue bar represents that range for each of the categories. The bars represent the average of the past 10 years, and the dots represent where we are currently. There are some outliers here, but in general, what we're looking at is an overvalued status for just about every category. The extremes that we've seen, if you look to the far right, you'll see utilities. Utilities are as expensive as they've been in the past decade. If you look second from the left, you'll see consumer staples. They too are at the highest level they've been in the past decade. This has been a pretty common trade over the past year. A lot of investors have been going towards what are believed to be blue chip companies, a stable balance sheet, great cash flows, and they've been essentially overpaying for those. And the idea there is these are people likely fleeing the bond market where interest rates are incredibly low and looking for stocks with dividends that look like bonds. And consumer staples and utilities have typically been those assets. The other large outlier that we see is the energy segment. In the energy sector, we're sitting at a 62 PE. This is actually quite typical for what you would see in a bear market for a large index, a broad index. There's clearly a bear market in the energy company segment right now. Oil prices are low. Energy companies are not making money. The E is low. Typically at the bottoms of these recessions and downsides, you will see very high PE ratios, and that is because the E is low. And then as earnings recover shortly thereafter, that E comes back down, pretty dramatically. But our takeaway from this slide is that just about every segment, there's not a lot of value to be had. So there's a lot of data on this slide, so I apologize, but what we're getting at with this slide is that long-term returns are associated with valuation, and that short-term returns are not associated with valuation. The reason we look at valuation is because we want to understand what kind of returns we can expect from the stock market. We know anecdotally and just intuitively that if you pay less for something and it earns you more money, you make more money. That's intuitive. And if you spend too much for something and you earn the same amount of money, you've made less. So what we're looking at here are the returns on the stock market, this is the S&P 500, since 1954 relative to the valuation levels in the preceding period. In the lower right-hand corner, each one of these dots represents a particular valuation level on the x-axis and a return level 1 year hence on the y-axis. You'll see there's very little relationship. It's essentially a random walk, and that also makes intuitive sense. Valuations are not the determining factor on your annual year-to-year return. Lots of other things are going on. There's politics, there's war, there's all kinds of natural disasters, you name the events, investor sentiments change. Lots of other factors affect the price movement of the stock market, not necessarily valuation. In the lower left-hand corner, we have 5-year returns relative to the price paid, and the price to earnings paid 5 years prior. You can see they're starting to kind of put themselves into a little bit of an order there. It explains, 5-year returns are partially explained by the valuation levels. It becomes real clear once you start looking at long-run rates of return that valuation is the determining, one of the largest determining factors of your return. In that upper left-hand corner, we have earnings yield, which is the inverse of the PE ratio. The lower the price, meaning the further you go out on the right-hand side, the higher return you get. Our current earnings yield is about 5.29%, and that's based on an 18.89 PE. We've had some more data come in over the past few days, so that PE ratio is a little bit higher. It's actually at a 19. But that has been historically associated with about a 7.5% expected return over a decade. That is below the 50-year average of 10. So over the past 50 years plus, the stock market's averaged about a 10% rate of return. With the valuations that we have today, they're associated with a lower number than that. Now, I will call out that this earnings yield is still a positive expected rate of return. It's simply more modest than it has been. And that makes intuitive sense given that interest rates have been are much lower than they have been over the past 50 years. Earnings yields below 4%, meaning a PE of 25 on the S&P, is associated with negative 10-year returns. And that is, we've seen that. If you had bought the stock market in the late 90s, as many people have, 10 years later, not a lot of return there. And the determining factor there was valuation. And here on this slide, we have we have both historical comparison and a comparative analysis. So as an investor, you really have 3 options. You have, with your wealth, you can put it in cash, you can buy bonds, or you can buy the equity market, and everything else is pretty much a derivative of that. As an investor, with those choices at hand, you can buy cash. Cash is paying you nothing. And if you're in Europe, it's paying you less than nothing. You're getting less than your money back. If you're in Japan, you're getting less than your money back. So what do? You have to do something with it, and that's forcing people into the stock market. You can buy bond market. Bonds are incredibly expensive by historical comparison as well. If you look on the upper right-hand side, what we have is the average, what we call the bond PE. This is literally just the inverse of the 10-year Treasury yield. And you can see we are now at an outsized valuation relative to what we've had in the past 5-6 decades. A 56.9 measure there, that is a Treasury yield of 1.85, which is very low. If you go back to the aughts, our average PE ratio then for the bond market was a 23.8. That's associated with an average of around 4% Treasury yield. And then in the 90s, we had 6% Treasury yields, was associated with a 15. You can see those numbers are, especially in the aughts in the 90s and the 80s and the 70s, those numbers are very closely linked to the valuation levels that we see in the stock market on the upper left-hand corner of this screen. These are the PE ratios for the 60s, 70s, 80s, 90s, and aughts. In the aughts, we had a 20 PE ratio on average. In the 90s, we had a 20. 80s, we had 12. And 70s, we had 12. And that was associated with much higher interest rates. So these two comparable assets, the outlier today is the bond market. Bonds are incredibly expensive relative to where they've been historically, and they're certainly more expensive than what we see in the stock market, and given our current 19 PE ratio. Down below, we have a comparative analysis, other segments of the stock market. We have them broken down by 4 categories. We have the S&P 500, which are large domestic companies. Then we have the S&P 400, which are mid-cap, tend to be smaller companies, faster growers is how they tend to work out. Their PE ratio typically is higher, and so we have this forward PE expectation in the lower left-hand corner. This is analyst estimates of earnings for 2016 relative to the price as of March 31st. We're basically sitting at fair valuations for both of those relative to one another. The EFI analysts are a little bit more bullish on our expectations there. That has a lower PE ratio, basically essentially earnings are going to grow relative to the price that we're paying today. That's a bit cheaper, but that EFI index, which is Europe and Japan and Australia, tends to run a little lower historically. So this proportion between S&P 500 and the EFI PE ratio is relatively in the normal range. The outlier would be emerging markets, which is on the column on the right, sitting at a 12 PE. That is an incredibly low level, and that is typically what we've associated with bear market troughs. This valuation, unfortunately, has been in existence for well over a year. Again, overvaluation can exist for long periods of time, and undervaluation can exist for long periods of time, but this is a level that we've associated with much higher expected forward returns historically, especially when you look on that kind of long-term 10-year basis. So, our conclusions. The S&P 500, U.S. domestic stocks, which is the majority of most client assets, are fair to overvalued based on a historical comparison. There's no ambiguity about it. The problem is, what else can you do? Relative to other alternatives such as cash and bonds, stock market remains inexpensive. Now, given that situation, our expectation is that in the absence of a recession and a dramatic downturn in earnings, we could expect these valuations to continue climbing, the rationalization being that bonds are too expensive and stocks are relatively cheap. People will continue to bid up, like those staples and utilities we talked about earlier, as a surrogate for bonds. That is until we eventually hit a recession and people bail out as those earnings fall. This TINA is an acronym for there is no alternative to stocks. Next bullet point here, overvaluation, it can last for a prolonged period. If we do start grinding higher and in the absence of a recession, we can expect the valuation to reach bubble levels, and that makes us really uncomfortable. What do we do in that situation? So at Coldstream, we've decided to start taking employing what we call a late cycle game, and what that really means to us is that we're going to be much more selective with our manager choices and our stock selection. We want to weed out a lot of the high flyers, more speculative companies, because we're likely closer to the end of this cycle than we are at the beginning, and we want to be more conscious of earnings quality and that stability of those earnings. And we want to be a little bit more conservative, especially with our manager selection. We want managers that know how to pick valuable companies that can weather whatever kind of recession or economic conditions might persist over the next few years. What that typically means is we're looking for higher dividend yields, lower valuations, and to buffer on the downside, and we're looking for strong balance sheets and free cash flow growth, or free cash flow at all is a good thing, and then that will allow for companies to be flexible and survive.
Thank you, James. This will conclude our second quarter call, which is a review of the first quarter. If you have any additional questions, please feel free to contact your portfolio manager or relationship manager, and we really thank you for your time today listening. Thank you.